A big welcome to our live audience for the Digital Health Investor Talk Show. I'm your host, Stephen Wardell. I'm the managing partner of Wardell Advisors, a digital health advisory firm, and the author of The Future of Digital Health. Wardell Advisors is helping digital health companies address issues around growth, fundraising, trade sales, and strategic alternatives, giving you more options in today's challenging environment. You can follow me on x.com/Stephen Wardell. Our show today is on the topic, Now We Need to Win the Scale Game. And our guests are Chrissy Farr, the founder of Scrub Capital, an early-stage venture fund, and the CEO of Second Opinion Media, and Alyssa Jaffee, a partner at Seven Wire Ventures, who sits on the boards of Caraway, NOCD, and Summer Health. This show is being recorded and will be included in my podcast series called Digital Health Investor Talk. Subscribe to our podcast on Apple and Spotify. We have new podcast links for the shows, so make sure you see recent episodes when you subscribe, or you may be on the old podcast pages. This is not investment advice, and we are not investment advisors. Here's the format of today's show. It's about 90 minutes long, and Chrissy and Alyssa will be joining at about the 4:30 mark. And before then, we're talking about the news of the day. And then when they join, we'll be talking about their topic of how to win the scale game. So with that, I'll move on to the first topic. We're taking questions throughout in the LinkedIn text chat. And our first topic is macro news. So I think that the big macro news, I think, is that the innovation economy of digital health, which is the young companies and the investors who back them, would really like to catch a break. And they'd like to catch a break in the form of the Fed cutting rates. And there was a promise a year ago that the Fed would be cutting rates in the new year. And cutting rates is really good for young companies because with high rates, there's no reason why big investors wouldn't just put their money in bonds and collect a decent return. But with low rates, then people become much more focused on growth stocks and willing to bet on young early stage companies that promise growth in the future. But the Fed has just held one of their two-day meetings, which concluded a few hours ago, and they've decided to hold rates steady instead of cutting rates. So we might have seen the Fed cutting rates as a signal that stock market levels would go up. If the Fed had cut rates, it also might have meant that VCs were feeling a little more willing to invest in companies. But if the Fed is holding rates steady, then that's deferred a bit. It's deferred a few months until the next Fed meeting. And the Fed cited rising uncertainty and also stagflation risk. And yes, those are risks, and those are good reasons why the Fed would not cut rates aggressively. But nevertheless, the macro environment could have gone in the direction of the innovation economy, and not this month, it looks like. Also, we've seen a lot of market gyrations with the NASDAQ going sideways for a week and is at about 17.5 thousand, but it's still down over 10% since the start of the year, causing a lot of anxiety from professional investors and also savers in their 401k. And then there's also hanging in the wings, there's the concern that we may have an overdue recession coming due. So most analysts had predicted a recession a year ago or even 2 years ago. The business cycle is expansion followed by contraction. The contraction is recession. You don't ever get to skip the contraction part much as we'd like to, but we seemed to be skipping that contraction part in the last couple of years of the Biden administration. And that may have been due to war spending, the U.S. spending on two wars being a fiscal stimulus that pushed out the inevitable contraction and recession. And that contraction and recession may be coming due now. So with that, I'll just, for our audience, feel free to throw any questions about macro environment in there. But I think there's been a hope on the part of young company leaders in digital health that we would see an improving macro environment over the last 4 quarters. And each quarter, we have not seen the pieces coming together, I think, to see an improved macro environment. And what that translates into is, I think there's 2 classes of young digital health companies. There's those that have a kind of a favored status today. You could call it a halo status today, and everybody else. So the halo status today is companies that are native Gen AI, are telling new Gen AI stories. Also, there's a lot of interest and a lot of money going into programs around GLP-1 drugs. Also, there's a lot of interest in investments in the pharma tech sector. That's software and tech companies selling into the enterprise software budgets of pharma for things like clinical trial automation or software drug discovery. Those are favored areas, and they continue to get a lot of attention, and they're even seeing potentially high eager investor interest and high multiples. And then there's the rest of digital health, which is where investors have been very slow to put money to work and have been more risk averse and demanding that companies meet higher standards before they'll invest. So I think that continues. And the hope was that we would see the Fed cut rates, we would see stock market levels continue to go up, we would see IPOs go out, and the capital markets that are very constipated get back into their regular cycle, and that continues to be pushed out by events, by developments. So next I'll move on to our next topic, which is trade journal news for the last couple of weeks. So for our audience on LinkedIn, feel free to throw any trade journal stories you want to in the chat, and I'll comment on it. First, I thought this was interesting. Today, Carta Health announced a Series B1 financing, $18 million. Congrats to the Carta Health team, their CEO, Brent Dover. I think this is a very interesting model for what fundraisers may look like in the future. So I have noticed and complained on this show that mainstream funds have not been as active as they could have been, that you sometimes see a round led by a corporate venture fund, or a round led by family offices, or a round led by European VCs. But we've seen just less activity than expected from mainstream American venture funds. But here is a deal I think could be a model for the future. So Carta Health, a leading provider of AI-powered clinical data abstraction, that's analytics, announced it's secured an $18 million Series B1 financing. It will use the money to accelerate company growth. The company transforms clinical data into insights. The round contains the greatest number of hospital venture funds I've ever seen in a round. The round was led by Brent Burns of UPMC Enterprises, that's UPMC in Pittsburgh, with new investors including the Memorial Care Innovation Fund, that's a hospital venture fund, Rex Health Ventures, that's the hospital venture fund of University of North Carolina Health System, Tampa General Hospital Ventures, Memorial Hermann Health System, Frist Cressy Ventures. The Frist family is a family that owns a big chunk of HCA, Storm Ventures, Paramark Ventures, and CU Healthcare Innovation Fund, that's Colorado University, and Mass Brigham General Ventures. So, so first, we're seeing a deal that's focused on clinical data. That's very interesting, and analytics. This is a hot area. But we're also seeing that somehow Carta Healthcare has managed to go out and win the favor of these health systems and their venture funds and put together a very powerful syndicate. And presumably this means that these hospital systems like the product and will likely have a preference in using the product in the future. So I think that what Carta's done is very impressive. I don't know how they pulled it off, but it's a model for how in a difficult fundraising environment you can put together a syndicate. And I think it makes it hard for competitors to raise their rounds and compete with these customers. And it's a model for others who are going to build companies that sell into hospitals and health plans. Of course, there's a whole universe of corporate venture funds for health plans as well. So that's my thinking on that. Another fundraise, Epicor Biosystems, which offers sweat sensing, wearable technology, and a cloud analytics platform, announced it had raised a $32 million Series B funding. The company's using the money to analyze biomarkers for kidney health and stress management. New investors in the round include Joyance Partners and Alumni Ventures. Very interesting. I think this is the old MC10 team, Massachusetts-based, putting things together for a new venture to focus on wearables and sweat analysis. It also indicates, I think sweat is going to be one of the next sensors on wearable devices. It's been a while since there's been new sensors added to devices. I think heart monitoring was one of the last to be added to devices. SpO2 was maybe the last one to be added to wearable devices. And now I think we'll see sweat analysis added in the future. This is Joyance and Alumni Ventures. These are not mainstream digital health venture funds. And so this is an example of these deals getting done without the mainstream venture funds. And so then I'll also mention another funding was Basil Systems, an AI-enabled intelligence platform for life science companies. raised an 11.5 million round led by Golden Ventures with Hearst Ventures and Argosy Capital. So another AI company successfully raising rounds in this climate. So so what we're seeing here, I think, is that fundraisers are happening and a variety of business models, and that they're favoring companies that have an AI story to them. So, and with that, I'll look to see if our audience has any trade journal stories they want us to cover. So I'm not seeing any comments from the audience on additional stories to cover. So I want to do a little bit of a deep dive and some thanks here to Healthcare Andy, and I'm getting this from his Twitter post. So this is Andy Mychovsky, who goes under Healthcare Andy on Twitter, and he's worth a follow. And he's noting that Teladoc Health announced recently that they had made a $30 million acquisition of Uplift Health, a small digital health company. So, and he does some running of the numbers for us, and he calls the merger analysis here brutal. It's brutal in the sense that it's hard for Teladoc to currently acquire companies, but they are actually doing it. And it's brutal because they're paying low multiples compared to what we saw years ago, compared to valuations as measured by private fundraisers and valuations as measured by prior acquisitions. Uplift is a mental health startup that was founded in 2020, so the year of the pandemic, and it was incubated by Redesign Health. And it has raised $22 million over the past 5 years. So right there, you can see that they raised $22 million over the past 5 years. You can wonder, what their post money was on their last round, but it probably was well over 22 million. Probably well over 40 million, probably well over that in terms of if you build step ups into each round. And then they were acquired for 30 million plus a potential performance-based earnout. And so, but if you just run some mental math on this, if you put money to work over the course of 5 years and what you get out is barely more than the money that you put in, that's not a great return, not something that people are going to want to do repeatedly. So, Teladoc's price was a $30 million cash purchase plus $15 million in potential performance-based earnouts. So Uplift's last year revenue, 2024 revenue, was $15 million, and they had an adjusted EBITDA loss of $6 million. So this is representative of young digital health companies, 5-year-old digital health companies, is that they tend to be earnings negative, which means that they default cannot survive without further investment in the company. And digital health companies seem to take longer to get to break even than other companies. And that's concerning because it will make investors shun the category or trade away from the category if that continues. So that means that the company was bought for about a 2x valuation. But in the past, we've heard of companies raising money and being valued at a 5 to 15 times revenue valuation or higher. And this is effectively a buyout of venture investors, so they aren't going to see more upside after this. And then Uplift probably tested the waters for raising further money, but decided to go with a $30 million sale of company representing about 2 times revenue, or not that much more money than had been put into the company in the first place. And they looked at raising a next round, and management looked at the next round and presumably decided that being acquired for 2 times revenue was fair. Teladoc, their stock trades at roughly 0.5 times revenue. So that is a low multiple. Teladoc's been down there for a while, and it's challenging for Teladoc even to pay 2 times revenue, even though that's a low compared to 4 years ago multiple number. And Teladoc is intentionally trying to build a better company here and acquire good assets out in the marketplace. But Teladoc could have taken that money and could have bought its own shares back. And so it's making a bet that it can do more with this asset and earn its shareholders a greater return then buying its own shares back with its cash, and it can buy its own shares back cheaply at 0.5 times revenue. So that's taking a look at this, and I think this shows that management has a shot at achieving that $15 million earnout, but in general, this is probably not a great sign for the previous backers of the company, and also there's key employees who got stock options. There's the most senior employees who are being kept on, who can earn the earnout, but the more junior employees and the prior investors are probably not seeing a lot on this deal, I would guess. And this will be viewed as one of the more successful M&As that's happening. We are seeing M&A deals that don't trade. We are seeing M&A deals where the target company runs out of runway, won't take low offers and runs out of runway, and then shuts down, and the equity holders get nothing. And so this deal is going to be seen as one of the more favorable deals out there. So I'm getting a comment from Bart that he can't hear me. I'm getting conflicting comments. I think I don't have the ability to fix anything on this. So I'm sorry about that, Bart. So I think what we're starting to see here is that young companies are running out of runway. They are having trouble raising a next round. Because of that, that's forcing them to become realistic about what their value is and sell at their value. And we're seeing a couple data points around the value of companies being at around 2 times revenue in an acquisition in this market. I've seen some other data points of acquisitions at 2 times revenue. So we can be sure that's going to be used by bankers as a reference point as more companies trade in the future. And that is a very disappointing exit revenue multiple, but it seems to be what's needed to get deals done. But it's very disappointing, of course, if you're an entrepreneur and we're counting on an exit and worked 5 of the prime years of your career to get to that exit. It's very disappointing that digital health companies are trading at 2 times revenue, it seems. 2 times revenue for an acquisition of a growth company, and 0.5 times revenue for a public company like Teladoc. What the earnout probably means is that management was very committed to a plan of achieving very high growth, and Teladoc was not willing to buy into that idea of that growth rate. It seemed too high to Teladoc, and so they kind of were able to separate that issue from whether the transaction trades or not by setting it to the side and assigning an earnout to it of $15 million. And if they achieve the high growth rates that management said that they would achieve, then they get that large bonus. But if they don't achieve those high revenue growth rates, then they don't get the high bonus. And that allows Teladoc to buy them today instead of waiting for the company to prove it's going to have that high growth rate. So I think that was a really helpful look at the numbers by Healthcare Andy, and any other stories that the audience wants to cover, you can throw in the chat and I'll follow that. So then I will move on to a next section, and maybe I can invite the audience more on this as well. But what is a technology that has improved your personal life? So I'm going to bring up one which is portable monitors are improving my life right now. So maybe for our audience, you guys can mention this, and I've used portable monitors on and off for a while, and they give you 2 screens when you're traveling, and they're affordable. And usually the business ones I've gotten were EP. EP is a moderate resolution monitor that was very common 5 or 10 years ago as the resolution of monitors. But more recently, monitors have gotten better resolution. And so I got a monitor. In the past, I've had like a 15-inch monitor, portable monitor that was EP. And more recently, I got a new one and gave away my old one. And the new one I got was more like a 16-inch monitor that was 2K. And so 2K is twice the resolution of 1080p. And both the slight size increase and also the resolution increase, I think, are really valuable, make the effective screen size much bigger, what you're carrying around with you, improve your productivity a lot, in my opinion. So I recommend those and like those. And we have a comment from Renee, who says, I love my portable monitor when I go to conferences. Yeah, you get used to multiple monitors these days at your workstation, and then you go in the field and you discover that you can really lose productivity with just one screen. It can be annoying and frustrating as well. So for our audience, if you guys have any other examples of tech that's made your life better, I'll I'll also mention that thumb drives have gotten smaller and smaller, and now there is a category called ultra slim thumb drives, and these barely stick out of your USB port on your laptop. And so this can be like having an external drive and something that, if need be, you can share with someone else, etc. But it's like carrying around an external drive. People used to do that in the past. Now you can get a very large in terms of data storage USB drive called ultra slim, which barely sticks, half a centimeter out of the side of your laptop, and you just leave it in, and you always have that spare drive as well. So those are some technologies that I have there. And as I said, I think we're expecting that Chrissy and Alyssa will drop into our video recording studio soon. So the next I'll go into conference reviews. So these are some upcoming conferences that I like, many I plan to go to. And so for our audience, I'd ask, can you guys throw some conferences into the chat? And are there other conferences that matter to you? What's the conference? What do you reasonably hope to get out of the conference? So I'll mention that coming up May 19th to 20th in Boston is the Digital Healthcare Innovation Summit, 2-day conference. And I think this is the best independent investor conference in digital health. So the best investor conference is the JP Morgan Healthcare Innovation Conference, and that's owned by JP Morgan. And people actually go without tickets and never go into the conference and just do meetings in hotel lobbies in San Francisco. That's a grand tradition there. And then there's the Digital Healthcare Innovation Summit. It takes place 4.5 months later in Boston, and it does a great job of bringing together Northeastern VCs, national VCs, but with an emphasis on Northeastern VCs, and also digital health companies. And what I do with conferences like this is I look at all the VCs who are named on the web pages, and then I throw in all the VCs that I know in Boston and New York. And then I just write to all of them and say, let's meet. And then oftentimes they will meet. One of the intriguing things I've heard about this conference is that people will often say, I like the programming so much that I don't want to interrupt the programming in order to do meetings. And so one way you can address that is I think the conference is Monday, Tuesday, is that you can stay Wednesday as well. And that's for the Boston VCs. And for the Boston VCs, see if they'll meet with you Wednesday when you're in Boston for the conference, but they work in downtown Boston. And so you'd be able to meet with them Monday, Tuesday, or Wednesday. And then I'll also add, in Chicago, there is the MedCity News Invest Conference. That's highly recommended as well. Also, May 20th, 1st, that's a Midwest Investor Conference. And then, interestingly, we talk about aging and longevity, and coming up June 9th to 12th, there's the Aging Code Summit, which is exploring longevity with AI conference in Cambridge, Massachusetts, which is about AI in the science of aging industry. And also mention, that Digital Healthcare Innovation Summit in Boston, May 19th to 20th. I have a discount code for audience members. It is DHIS25, partner 25. I'll put that in the chat. And then Stephen on the call says, last week's Becker's in Chicago is a great one. Also, ATA just occurred from Saturday to Tuesday. I assume that's the American Telehealth Association. Thanks very much, Steve, for both of those. And hooray, so we've just added Alyssa Jaffee to the call. Alyssa, this is streaming to a LinkedIn Live page, and we've just been going through the news of the day with the audience. Welcome to the show, Alyssa.
Hey, good to see you. I just want to make sure my audio's okay, that you can hear me.
Yeah, thank goodness. It's very good. I can hear you. And for our audience in the chat, maybe you guys could comment as well. But as far as I can tell from being in the studio room with you, it sounds great.
Amazing. Good to see you, Steve. How are you?
Thank you. Yeah, great to see you. And we were just talking about upcoming, and so we're waiting for Chrissy Farr, but we'll also jump into our agenda for the day. But before you joined, we were just talking about upcoming conferences and what they're useful for. So I talked about the Digital Healthcare Innovation Summit in Boston, which is an investor conference, and also MedCity News Invest, which is later in May in Chicago. And Steve Rubis, who's a former sell-side analyst, he just plugged Becker's Healthcare Conference in Chicago as well. And Renee in the chat just said, I learned about the Lake Nona Impact Forum,
Yeah.
which hosts top CEOs and healthcare innovators, but it's invitation only. Thanks, Renee. I had not heard of that one. I'm going to look that one up now.
It's good.
And
It's a really good one too.
Britt in the chat says that they can hear both of us well. So that's great.
And I can't see the messages you're reading.
So let's see. I will. That's right. There's a LinkedIn page, and I'll just read the relevant ones aloud for us to chat
All right,
about.
cool. All good.
And so while we wait for Chrissy, by the way, do you have any conferences you're planning to go to that you recommend for our audience, and then call it in the next 2 months that are especially good? And what do you get? Why are they good? What do you get out of them?
Yeah. Well, next week I'm speaking at the McGuire Woods Conference in Chicago. It's my panels myself, Jaffee Gallagher, who's the CEO of Endeavor North Shore Health System, and Steve Klasko, who used to be CEO of Jefferson and now is at General Catalyst. So it should be a really fun time. I've actually never been to their conference, so it'll be really fun and it's supposed to be a good group. I just did Health Evolution Summit, which is just a fantastic group of people, great leaders. A lot of the incumbent organization leaders go, just really collection of strong innovators. So I find that to be a really good use of time. And I always do the big ones. Like for me, HLTH Health is great, and JP Morgan I think we all have a love-hate relationship with. But I find that some of the smaller conferences, whether it's Health Management Academy does their Strategic Provider Alliance, those types of things, or some of the ones you mentioned, like Nona is a bigger one, but it's really cool because it's just the content is so impactful. But just trying to find maybe some of the smaller ones. Chrissy's at one right now in Puerto Rico, actually. So maybe that's why she's having some connectivity challenges. But I think she and I were chatting earlier today, like what gets kind of me to leave my family and my kids and to go to these conferences, I find really the people and the people that they're able to recruit. And when it's really just like a fantastic networking opportunity to meet all types of people, like that's really where I tend to lean in these days.
And the Health Evolution Summit, that's one that I've never been to, and I think it's hard to get a ticket to, but my impression is that they're successful at getting CEOs of provider systems and also payers to attend. That would be very valuable to a vendor who's trying to sell into a provider or something like that. But is that accurate about Health Evolution Summit? They managed to get the CEOs of the big systems.
They do. They get a lot of execs from incumbent orgs, so they do a really nice job of that.
That's great. Well, so why don't we launch into the main topic of the show, and when Chrissy joins us, we'll get her perspective as well.
I think she's waiting to be let in. I don't know if she's in the waiting room, she said.
So I'll make sure that, one second. So on my side, it's not showing her sort of knocking on the door to be let in. And so I'm going to, hold on a second. So I just resent the link to make sure. But on my side, I'm not getting any kind of signal that says that someone is in the waiting room waiting to be added to the studio room. There's no button for me to press. So with that, why don't we jump into Alyssa, the origin of this show is that you and Chrissy published a kind of a call to action. And the call to action was about how everyone knows the story that there's been massive investment in young digital health software companies up through the downturn a few years ago. But what we don't hear about is that the big incumbents of healthcare, so the big health plans, the big hospitals, the big pharma companies, have doubled in market cap or more and have become enormous. And that there's a risk that young software vendors who have a clever product that creates some value in a process of a major incumbent in the healthcare system will be ignored. That they won't be able to matter. They won't make a difference to these giant healthcare companies. And that wasn't the case 5 years ago or 10 years ago, but it's increasingly the case today. And so I just wanted to hear, you're at a VC fund, you're in a position to see this, and I was hoping that you could just lead off by telling us about what you noticed and the origin of the article that you guys published. And I see Chrissy now, so here she is, so I'm going to have her join us.
Sure. Well, you add her. I'm happy to kind of give the premise. Would it also be helpful to folks? Do we do intros, or I guess folks had seen our bios?
That's great. Yes. Why don't you introduce yourself? So Alyssa Jaffee, partner at Seven Wire Ventures. But please introduce yourself.
Sure. Perfect. So hi, everyone. Alyssa Jaffee, partner at Seven Wire Ventures. We invest in healthcare technology and tech-enabled services under a thesis we call the informed, connected health consumer. So everything we do is how to help people to become better stewards of their health and how we think about healthcare technologies and services meeting people where they are. We're an operator-driven model. We invest in companies. We start companies, most notably Livongo. And 50% of our LP base are strategic organizations. So the customers of our companies like health plans and health systems. I myself am operator turned investor, launched enterprise technologies, did solution selling, managed teams for the advisory board before they sold to Optum, went to business school, did a bunch of stuff, started a company, sold a company, worked for the Pritzkers, and came to Sevenware about 7 years ago. Hi, Chrissy.
Hi, nice to see you.
Hey, welcome, Chrissy. Great to see you. And you've arrived just in time for introductions and would love to have you introduce yourself to our audience.
Okay, excellent. So hello I'm here in Puerto Rico. I'm at the conference SAIL, which is, it sounds like it's a holiday, but it's actually a real conference on the topic of health and AI. So definitely that is a topic that I've been spending a lot of time thinking about the past few days. In terms of introductions, I have a background that really spans media, venture capital. I find myself now in more of a consulting advising role, working with digital health companies, primarily on the fundraising. It's not easy to raise capital in this market, as Alyssa knows well. And that's definitely a focus of mine these days. And then I run a newsletter called Second Opinion, which is all about the health tech industry. And I have a fund myself called Scrub Capital. I'm one of 3 GPs, and we have a little bit of a differentiating model in that most of our LPs are actually practicing clinicians. So happy to chat about any of that or just whatever you want. And really happy to be here with Alyssa, who is, funnily enough, one of my dear friends in life, in work, and just in all the ways.
In all the ways. And we were just chatting. So Steve asked us, he said sort of like the precipice for why this started is you and I wrote an article about kind of how digital health exits have changed and like where did that come from? And so I'm happy to sort of kick it off of a little bit of like our philosophy there, and then you take us, Stephen, to where you want to go.
But did you share, Alyssa, where we actually wrote a lot of this article?
I did not. Chrissy and I were in Paris. We escaped our amazing, beautiful children and families and went for a weekend to get some quality time together with another friend in the, it's an hour plus Uber ride to the airport. And we actually wrote the article in that Uber. It was a very productive trip.
That's great. Well, so Alyssa, you were saying that you guys noticed that everyone knew the story of young companies raising unprecedented amounts of venture capital, but no one knew the story of the incumbents and consolidators becoming too big to even notice the young digital health companies. Can you go into that beginning?
It wasn't too big to notice. So I just want to be clear and maybe caveat a couple of things you said. So I think one of the examples we use that's a good illustrative example is, in 2020, a business called Able2 was sold to Optum for $470 million. At the time, Able2 was about 50 million top line in business. And so a $50 million company was interesting to a health plan. And fast forward today, now 5 years, and these health plans have grown 3-4x plus. And so no longer can you be a $50 million business to be acquired. You have to be 150, 200, $250 million business to get acquired, because just to make impact in some of these organizations. So I think historically, who we've always thought of as the strategic buyers, they still very much are buyers of digital health, but they are buyers of much larger companies. So it's not that they don't know who these companies are. It's not that they aren't tracking and working with, and in many cases have commercial relationships with these earlier stage companies, but they are now in a place where there's a bit of a gap. And the path to build a business that's over $200 million in revenue takes a very long time. The stamina that it takes, the path that you go down. Chrissy and I are both very close. The company I sit on the board of, NoCD, they're a business that has just had tremendous growth. And if you look kind of externally, you're like, wow, this has been up and to the right. But if you ask Stephen, it's really put so much time and effort into building this. And his business is now becoming really attractive for a lot of optionality. And so I think the big question becomes for companies, not every company is going to take that path. Not every company is going to become that big. And so what are some of the things that they have to do in order to still maybe achieve success? And whether that's a different kind of exit, an exit they thought was going to look one way and it looks different. Is that a merger? Is that them becoming the acquiree instead of the acquirer? Or is that, we're going to muster up, get the resources, raise the financing, and build to that. And that's where I think the point she and I were trying to make is that the incumbencies have just changed so dramatically in the last 5 years through the course of the pandemic. And I think that digital health needs to catch up to understanding what the needs of those strategics are. Chrissy, parts I missed or things to add?
Yeah, I think you and I have both written investment memos, and I think we've collaborated on a couple of them. And there is always a section in an investment memo where investors will look at what is the plausible exit path for this business that they're investing in. And with health tech, I mean, it's just getting less and less plausible that exit pathway is going to be an incumbent, unless you have a really good reason for believing that that's the case. I think there are other reasons why incumbents have been less acquisitive of late, and some of it is kind of related to more regulatory concerns and whatnot. It's also, what Alyssa said is spot on, that these companies just have to be bigger to rise to the level of attention to some of these big companies that might acquire them. And they also have to be a little bit more pristine in terms of their unit economics. In the old days, you could just grow and grow and grow and have a lot of revenue. These days, you need to be profitable, if not, very close to break even, which is another change that we've seen. Much more focus on how do we create profitable companies, and that means oftentimes you have to think about whether to sacrifice growth, whether or not to make your company a little bit more lean, maybe less bloated as an organization. And you see a lot of companies building that today, just in ways that seem a little bit more conservative. So it just felt like time to reevaluate what it takes to exit a digital health business, which I think was the start of, or the starting point of doing this piece. And that was just one idea we wanted to throw out of potentially many.
So that's really interesting. And I almost hate to bring up this word, but the word is medtech. And so the medtech sector is a troubled sector because, among other things, the medtech companies usually can't go public, and they can be sold only to a small number of consolidators who themselves have gotten very big over time, and like Boston Scientific and J&J. And so if digital health, which is quite distinct from medtech and doesn't require FDA clearance and was often seen as having an easy ability to go public, but not lately, and will medtech face a similar issue of not being able to go public, which they can't today, but also not having a lot of incumbents interested in acquiring them because they're too small, because they don't matter in terms of revenue size to those incumbents. So I hope it's not heading down the pathway of medtech. But any thoughts on that, Alyssa and Chrissy?
Yeah, I think you're conflating a little bit the challenges of the public markets and then what's happening in digital health. So I just want to be careful. Like, the IPO lockup that's happening right now is systemic across industries, not just digital health. I think certain industries are popping, others are falling, but I think predominantly everybody's feeling the squeeze. So I don't think that this is like a pervasive issue that only digital health faces, and thus is going to have this newfound headwind that will never be left alone. Like, for everything you just said in the beginning, we don't have FDA clearance. We typically are asset light. We historically are high margin or strong margin businesses. We're hyper growth companies. All of those things there's a lot of likability. And the general public markets are now favoring a bit more, to Chrissy's point, stability in unit economics and profitability. And so the companies have to pivot to that. But I don't think that there becomes a convergence in the two types of assets, because they're quite different, to be honest.
That's great to hear. And then I think there's been under consolidation in digital health for a while, but we have finally seen valuation levels of young companies fall to the point where we're starting to see consolidations. And so, for example, Teladoc just announced that it acquired Uplift, which had about at about a 2x revenue. I'm sure that the people behind Uplift thought they would sell for a higher multiple when they began their journey in 2020. But that indicates that young companies are willing to sell, at a relatively low valuation level of 2x revenue. So do you think that we're going to see more acquisitions in today's climate at lower valuation levels, perhaps with big challengers? What is Teladoc? They're kind of a big challenger as opposed to an incumbent. doing the acquiring. Maybe also a PE platform, like I think Personify is backed by PE, and they were the merger of Virgin Health and Health Comp. And so is that the model for us to see more acquisitions like that?
I mean, I did a piece on this that for Second Opinion a while ago that was actually pondering why we haven't seen more private equity activity, because my thesis coming into this market, and to your point, you see lower revenue multiples both in terms of M&A and in funding on the equity side. So I thought we would see more PE activity, and I've actually been surprised that we haven't seen very much. I can think of like some examples in digital health, but we certainly haven't seen the like employer roll-ups that we expected to see and people have been theorizing about for a long time. One of the kind of conclusions I came to, having spoken to friends in private equity, is just that it comes back to this unit economics problem. If you've been kind of sitting it out for a number of years during COVID, maybe you just, things slow down. Now you're under pressure to do a deal, which is a good thing, right? But you also want that first deal out the gate. It's been your first deal in a while to be a really strong company. And I think part of the problem has been that digital health has not had quite as many just, huge blockbusters in terms of really strong growth rates, lots of revenue and profitable. And there are companies like that out there. I can think of a number of them. I'm sure Alyssa, has been attached to some of those companies in her role as a VC, but they don't necessarily want to be merged with other companies by a private equity firm. They may have their sights on an IPO once the IPO window opens up. And so I think there is that disconnect. I feel at PE, if they were willing to do the work and pick up some of the assets that maybe weren't quite so pristine, I think they could actually find some really interesting gems. And if you found a firm that was willing to do the strategy and the deep work to figure out a path forward for those businesses, that could be really interesting. But again, it goes back to this problem of just like this holding period that we saw during COVID. So who knows what's going to happen in the next 12 months? Like the market is just incredibly volatile, but that is my theory when it comes to private equity.
And I have a view out there. So when I was a sell side analyst on Wall Street, I was saying publicly in the 2016, 17, 18 timeframe that there has consistently, so I date the start of the modern digital health era to 2009, which had two things happen in 2009. First, there was the global financial crisis followed by the Fed's zero interest rate policy. And the second was meaningful use of $40 billion subsidy dropped on the heads of hospitals to buy EMRs. And so this was like the starting gun of modern digital health. From 2009 through 2022 or so, you had massive kind of over-entry into digital health, partly driven by the zero interest rate policy, over-entry of products, over-entry of companies, over-entry of venture, over-entry of talent. And then in 2016, 17, 18, 19, I was saying there's been under shakeout and under consolidation in this sector, and I think we'll see more shakeout and consolidation. And I was wrong, and it didn't happen. And now we're at a period where interest rates have gone back up, and young companies are having trouble raising money. And so I think we finally will see that the mother of all shakeouts and consolidations happen. But it's been, Chrissy, to your point, it's been much slower than I would have thought. I think companies were they were extending their runways instead of trying to grow fast, and now they're at the end of their runways. And I also think digital health CEOs don't quit. So there's other CEOs in other industries, in gaming or in crypto or in cybersecurity, who, if their sector has a problem like this, they would quit. But I think digital health CEOs, by their nature, they're often in this partly for cause-related reasons, and so they're kind of sticking it out. They don't want to leave their diabetes solution that works and that would have helped their family member in the lurch. So I think that's playing a role in our sector as well. So any thoughts on that?
Yeah, I mean, I guess I think one of the systemic challenges that's different than venture has always been this quote unquote game. It's always been you swing for the fences, two or three companies drive the majority of returns in your portfolio. You try to soft land some are doubles and triples. Like that's not different 10 years ago versus today. The difference is the longevity of how long companies are lasting. And I appreciate like the digital health CEOs don't quit. I think that there is a unbelievable and has been an unbelievable amount of capital at the early stages in the last couple of years. And so companies that probably should have never gotten funded or got funded maybe in a pre-seed or a seed, that then wouldn't, again, didn't hit the milestones, didn't get the traction at that point, would have sort of died on the vine, made it a couple of additional rounds before doing so. And at that point, with that level of cash in the business, I think investors sometimes are reticent to say, we're going to sunset this thing because there's a bigger position at that point. And so I think it's maybe a bit more of a product of that market dynamic than it is necessarily of just like the type of entrepreneur that signs up for digital.
Yeah, interesting. Thank you. And so Priya in the audience asks, given that you think companies need to grow more and become profitable, do you see opportunities for smaller mergers happening before bigger strategic acquisitions? So I guess that would be like the recently announced Teladoc acquisition of Uplift. But any thoughts on will we see a wave of small acquisitions happen to sort of build assets to become big enough?
I don't think that maybe Priya, you tell me if I'm answering your question. I don't think she's saying because Teladoc is already public. So they, so I think it's if Uplift and another company of the stage merge together to grow bigger. I think that's actually what Priya's asking, not more companies selling to Teladoc and sort of like tuck-in acquisitions.
Sure. Yeah.
I can't see the chat, so I have no idea what Priya's saying. But hopefully that's what she's asking. I'd say like for sure. I think that's, we did that recently, where there was a 1 + 1 = 3 and we combined Caraway and Summer Health because at the end of the day, while Caraway was focused on Gen Z population and Summer Health was focused on peds, most kids are now staying as dependents on their parents' plan through age 26. And so, what is pediatric care was the definition of it was evolving. And so what Caraway brought to the table, what Summer brought to the table just became sort of a natural combination of those two. And we realized that the business could grow much more quickly. And Chrissy and I were part of this it could grow a lot more quickly with those two assets being combined. So I think, it's definitely something that we expect to see. I think it's just hard because most of these assets are losing money. Not all of them have traction, how to value them, how to bring teams together, the cultural kind of intricacies of bringing two different CEOs and who's going to run the business. Like all of those are hard and it has to make sense even at that stage.
And you have to, oftentimes that it comes with some financing and you have to find VCs that are again like willing to do the work to figure out kind of what is possible in a scenario like this. And it is, to Alyssa's point, much more complicated. Even the question of who is going to be the CEO is, can mean hours and hours of discussion and lawyers and whatnot. So I think it probably could happen, especially given that it is so difficult and tough out there to raise capital, but it's not easy. It's much more challenging than it might seem on the face of it.
So you guys probably know John Moore III, who was the son of John Moore of Chillmark. So he's in the chat and he asks, would you say that you're seeing the shakeout, consolidation, and shrinkage of digital health companies that you would have expected going on right now, or is it higher or lower? And to me, I'd say that we are seeing some, and it's not nearly as much as I would have expected. I would have expected a much bigger announcements of companies running out of money and shutting down, or a much larger acquisition by mid to large size consolidators of young digital health companies. But do you guys think what we're seeing right now is the shakeout and consolidation that we're due, or that it's going to grow much, or that it's an under shakeout, under consolidation that's going to grow much more in the future?
I think we're going to see a lot more shutdowns in the next 6 months because, if you think about it, it's a maths question. Like if you raised a boatload of money during COVID, at some point you're going to run out. And it's very possible that you could have kept going, especially if you had a very lean operation, your burn wasn't very high. It's possible that you could have kept dwindling along until this point. And if you've been out trying to raise capital for, more than 6 months or even a year and it hasn't come through, I think a lot of companies will be forced to kind of really evaluate their options and, maybe return money, what's remaining, or just make the decision to shut down because they've just run out of money. Whether or not we see any of that in the ether kind of remains to be seen because a lot of companies just quietly shut down and they don't announce it. I personally am a fan of announcing it, and I know it's tough. And I don't necessarily mean like a press release, but I mean acknowledging it, because we learned so much more from stories about why things did not work than we ever learn from just like the endless parade of headlines about companies raising capital and crushing it. I would love to see more of that, but it's also a very hard thing to do. And as I've known founders that have been faced with this quandary of whether or not to kind of shut down quietly or say something, I don't envy that predicament because it's not easy. It's like in many ways can be a deeply emotional experience. So I sort of leave it to the founder, but would love to see just selfishly kind of more explorations of why things didn't work as intended. Your thoughts, Alyssa?
I think that's, first of all, the more transparency that we can give on things that are happening and why, I think it helps everybody grow, and it creates real kind of badges of honors for many super successful CEOs had plenty of failures in their past. And I think it's the resilience and the determination of why they do things. I'm a little bit less on the scale. Like, I think, yes, businesses will shut down. I think that's a bit of the nature of this. And again, just because there's less capital, it's hard to access capital today. Those who will run out of cash will have to do something. I hope to see more M&A. Like, I hope to see more creativity coming from us. Like, we have so many companies going after the same problems. And I think there's just been a lot of reticence to work together because of ownership, and again, a lot of the things that we talked about in terms of merging companies, and honestly ego too. And I just would love to see us be more creative and to say, look, like, to make this thing happen, this is what we've got to do, and let's try to build it together.
That's great. Thank you. So I think we talked before about winding up in about 10 minutes. That's still fine. Or if either of you can stay longer than that, that's great. We've had a bunch of audience questions. I'll try to get to them. But let me also jump on that same question that you both addressed. So I've often said, as a sell-side equity research analyst covering digital health for investors, that there's far too much weight given to announcements of inputs. The input is someone's joining a firm or capital's going into a firm. And in digital health, especially, even compared to other sectors, there's not a lot of analysis of outcomes. Capital went in. Did a big return come out for investors? Products were built. Were the products, did they provide clinical value and economic value for the buyer at the end of the day? So we undercover that. We know less about that. There's less transparency about that. That's too bad. We sort of need that. And so that's a fault of the sector, I think. And then also I'd echo what I heard before, which is that for a founder, this might be the worst thing that's ever happened to them professionally in their lives, and they might feel like it's a moment of terror. They've terribly let people down. But it's a long ball game, and people are very forgiving, and every single successful founder has been someone who's had failures. From the retrospective of 5 years in the future, people looking back, they'll remember that you distilled some wisdom and you got some benefit out of the shutdown of your company. So I would also say that people should write reflective pieces on what went right, what went wrong, and everyone will gain when they do that. Steve Rubis, who's a fellow sell-side equity research analyst, is in the audience, and he asks, how do you guard against the quandary of successful digital health IPOs? Or actually, he had two questions. Let me go to the other one first. How do you exit in digital health if there are no IPOs? Interest rates are likely too high to easily raise cash. Does one need more profit than growth? What are the metrics to look for in a deal?
Sure, I'll take this one. So there are exits, and I think that, again, this is a really tough market. And I think the heyday of the pandemic made a lot of people bright-eyed and bushy-tailed, and I think we've pulled back a lot, and therefore it's really challenging. So the IPO market still exists, but what I will say is I don't have the data. I'm sure many of you very smart people on this call do, that it's like 0.0001% of people that raise venture capital dollars will go public. So like that is not going to be your exit. I think that is very unlikely. And so if you are raising venture dollars, one is some people, you have to be okay that the company may outlive you. Every time a company triples, it breaks. And are you the right person to run that business? And sometimes the answer is heck yeah. And sometimes the answer is, you know what, there's somebody who's better for this level or this stage or this scale. And so I think that's, part of the cyclicality. But there are absolutely exits where We just said, companies selling to other companies and creating some earnout strategy for some of the employees from one company to the other. Selling to private equity. Now you have to be a profitable business. But many PE firms are building platforms and they're looking for tuck-in acquisitions to build to that. Selling to strategics, not just selling to the health plans, but also selling to the tech companies. You look at CVS and how acquisitive they were, but you also look at Amazon and a lot of the work that they did as well. And so I think there are a number of paths, but typically venture-backed businesses, it's a real swing for the fences game. And a lot of companies won't always be successful because of the nature of the type of company that we're trying to build.
Maybe I would add there as well that I do think that the IPO, it's not a super open at this moment in time. I think we saw with Hinge that there was a report that they may kind of not do the IPO as intended. It's just there's a lot of uncertainty.
Today I saw that they said they're now moving forward as intended.
Okay, so
I know.
Let's see how that goes.
Real
if that one does well,
fingers crossed.
Fingers crossed. There's been some jokes around the digital health industry that we should all be buying into this IPO and getting some Hinge stock, because if this one does well, it really sets the tone for the rest of the industry. So fingers crossed. But then I would also say that their companies are getting creative, and a lot of companies don't view the IPO as the end point, and they don't view the IPO as even all that attractive in the near term, because you have to do all this quarterly reporting. It becomes much more challenging to innovate once you're a public company. So I don't know, I was having coffee a few weeks ago, and I'm not going to name the company, but it was a business in digital health that is kind of under the radar, and they are spitting out $1 million a month right now in EBITDA. They're very profitable, have been profitable for about 3 years. And I said, are you thinking about an IPO? You would do well. And the CEO was like, right now, we don't really need it. We have plenty of money. Every round has been oversubscribed. We've never even had to go out and fundraise. And there is liquidity to be found in the secondary market, right? There are ways that you can delay IPOs these days. And a lot of VC firms are now oriented to those sorts of maneuvers as well, for better or for worse. But you see companies delaying going public for all sorts of reasons, and I think sometimes that can have a little bit of a dampening effect on the rest of the sector, because people don't know that they're great businesses in digital health. Right now, it's kind of a best kept secret of an industry, because everybody is tracking to what's happening in the public markets and what are the multiples that we're seeing in the public markets.
And Chrissy makes a great point on the interim exits, the secondary market, because again, there's different milestones. What an early stage investor needs and what a later stage investor needs are different. And so someone may say, or fund size, a big AUM shop versus a small fund. And so you can satiate a lot of people in different ways by having some of those types of exits.
That's great. And so you raised a thought just a few moments ago I wanted to return to, which is that there's kind of a mental framework that many people in the innovation economy of digital health, the young company leaders, and also some of the investors I've spoken to, a framework about the future, which is that the Fed raised interest rates rapidly by 5 full points a few years ago. And this caused a lot of caution on the part of VCs who had just raised big funds. And so the VCs had the luxury of kind of pausing and investing less and raising standards in the rounds that they were investing in. And the portfolio companies tried to push out runway. So they deprioritized growth at all costs, and they prioritized getting to profitability and pushing out the runway. Most of them are still probably not profitable. But then the thought was that these venture funds have the dry powder, and after a few years, there will be there will be a new understanding of the new equilibrium, and then and there's a joke that it's actually damp powder, not dry powder. And then after a few years, the VCs will start investing again into young companies, maybe with different standards they're looking for, but that they would invest this money. And so all those digital health companies had to do was just wait this out and make it to maybe the year 2025. When it would become easier to fundraise at that point. And so what I'm wondering is, does this, looking from the perspective that we can look forward almost halfway through the year now at the next 6 months, do those VCs still have that dry powder, or is it mostly invested by now? And will these young companies get the investment? Will conditions get better, and will that money be invested in this year? Or might these companies that tried to push their runway out, might they run out of cash and still not be able to raise money because things have actually gotten more chaotic? Things we were counting on, the Fed cutting interest rates, the IPO window opening, still haven't happened in the second quarter. So are we about to return to more investment in young companies, or do you think it's going to be that this date has been pushed out further? Does that framework still hold, or maybe the investors don't have the money because they invested it in other ways, or they're not going to invest it? And will the young companies be able to access that money? Will things return a little bit to normal in the next 6 months or 12 months, do you think?
Yeah, I mean, I'll start with some thoughts and then hand it over to Alyssa because I know she's got a lot of them on this topic. I think I've been calling it a have and have nots market for a while. I am still seeing companies with pristine unit economics or just in really hot spaces like AI and longevity be able to get many term sheets. In some cases, rounds that are oversubscribed, in some cases, rounds that are preempted. And then I'm also seeing companies that are really struggling. And these may be companies that would have raised quite easily in the kind of pandemic heyday. And there is some mob mentality happening now in VC land where this kind of fear of the scarcity of capital is causing a lot of VCs to kind of retreat to investing in things where they think that somebody will do the next round. And so that kind of takes us to some of the trendier areas that I mentioned. And I think we're missing some potential diamonds in the rough. I think we're missing some companies that have real potential. And because they're doing things that are less kind of hitting on the zeitgeist right now. And I think it's a shame. So there is definitely that dynamic. In terms of dry powder, it really depends. Some VC funds, like you got to be a little bit wary if you're a founder, because they haven't been able to successfully raise the next fund, and they still continue to actively meet companies, but there really isn't like money to invest. And I've seen founders get, or think they've got a verbal on a term sheet and then it doesn't show up for this reason. So it's, I think it's a moment to be very, very cautious. At the same time, I've chatted with friends who are kind of more multi-stage firms that have huge AUMs, and they've told me that it's actually, they're finding it challenging to deploy the money that they have, particularly in growth stage deals, because in their mind, they're just not seeing a lot of really strong growth stage companies in digital health. I don't know if I agree with that. I think I'm actually seeing quite a number of really good growth stage companies in digital health, but I'm sure those companies are extremely attractive when they go out, and there is just a ton of interest because you have these big funds that I mentioned with huge AUMs that really need to deploy very, very large checks into companies that they believe can be worth many billions of dollars, and it's hard to find those companies in digital health. So those are just a few thoughts. I think it's a great question. Over to you, Alyssa.
Yeah, I think Chrissy's right. Like, there is dry powder out there. We have 2 funds that are active, and we just started to raise our next funds. We are able to do deals. I think where the kind of love lost is on creativity. Taking an interesting asset that maybe like had some hair on it, but you're like, oh, this is cool, whatever. Like, I think the bar is higher, and it's higher for everybody. Like, you can't. In the pandemic, some of my companies were getting term sheets in a day. And I was like, what is happening? Like, this person's on your board for 7 years, And I think now that those days are over, which is okay, but there's high scrutiny. You have to know, are you pitching to a healthcare specialist fund or are you pitching to a generalist fund? And if you're pitching to a generalist fund, the healthcare team may love you and then go to their generalist partners, and their generalist partners may say, nope, we don't want to do anything in healthcare. There's a lot of keeping up with the Joneses on AI and just kind of like lemming-like behavior of, that's where you see some of the highest checks and just highest valuations come in because of the market that it's in. And to Chrissy's point, like, ask the questions. When did you raise your last fund? How much do you still have in dry powder? When are you raising your next fund? You can quickly.
And when was the last time you did a deal, right? And like, what kinds of deals are you doing? Because if they haven't done anything but AI for the past year and a half, they're not going to do a tech-enabled services deal, probably.
Yes.
So interrogate the heck out of that.
Exactly right. And it's also partner specific. Like, that person who's backing you, why are they backing you? What are they excited about? What kind of deals do they do? If you're pitching them a company, to Chrissy's point, a tech-enabled services deal, and they only do SaaS, like they're not gonna be your fit for you. And so I think it's just important to do your own diligence in these processes to make sure you're not caught flat-footed. But I do feel the bar is a lot higher. And, we've always had a high bar. Like we only do 2 to 4 deals a year. So we're a super concentrated portfolio. And last year we saw 2,000 deals and we did 2. So like it's always a super high bar. It's always been our process and our pace. But now I think a lot of people have a slower pace and therefore a higher bar.
That's great. Well, thank you both so much. And just any concluding thoughts. And the theme of this whole show was sort of winning the scale game. So maybe any concluding thoughts on what a CEO in the audience should be thinking about to win the scale game.
This is still
I think mine.
Yeah, go ahead.
Go ahead.
Go ahead.
I think my only parting thoughts, and I've never been an entrepreneur really of a health tech business, so take it with a grain of salt. You guys are doing the really hard work, but mine is just don't die is my philosophy right now. And I find myself saying this a lot. Like if somebody's offering you money, you should probably take that money. Like if you have opportunities ahead of you, just keep going. Like there are so many things that will make you want to quit, both because you're in a really tough sector, really slow sector. Like health tech is not easy, guys. Like we're, some of us have been doing this for 15, 20 years, and it feels like not much has changed. And many of the same companies are still at it, still deeply in the trenches. So just keep going and don't die.
And, Glenn always says, my partner, Glenn Tolman, who was the CEO and founder of Livongo, he's CEO and founder of Transparent. He says, if they're passing the hors d'oeuvres, you take one. Whenever they're passing you, so if someone's coming and offering you money, you take that money because you don't always know what the market's going to be and what it's going to need. And my perspective is this is a massive market. This is one of the biggest opportunities, but it takes longer. And there are a lot of better ways to get rich quick. So if you are trying to make money as fast as possible, I suggest you should not be in healthcare. If you are trying to really build something that is a generational business, that is long lasting and can make big money in the long run, this is a place to be. And so to Chrissy's point, it's one foot in front of the other. These companies are not, they look up and to the right, but they go like this and go like this, and there's ups and downs and challenges. And so just recognize give yourself some grace in the day-to-day that happens.
Great. Thank you. Well, that's a wonderful note to close on. Thank you both so much. Alyssa Jaffee of 7Wire, Chrissy Farr of Scrub Ventures. You've been listening to the Digital Health Investor Talk show with your host, Stephen Wardell. Our next show is Wednesday, May 21st on What's Working in Digital Health with Amrit Punjabi, the CB Insights analyst of digital health. And we'll see you next time. Thank you both so much, Chrissy and Alyssa.
Thank you.
Thank you.